Greetings, my name is Kevin Matthews and I am the tax professor. I want to welcome you back to class here at the Tax Academy. Remember, class is still in session because the learning never stops. And so today is going to be the fourth video in our four-part video sessions where we're going to talk about passive loss limitations. Now, in the entire video series, we've been talking about loss limitations as a whole. This is kind of the graphic that we've actually been bringing up. And so the graphic, as it says here, you have the basis limitations, at-risk limitations, and the passive limitations. And as you recall in the previous videos that we talked about, and by the way, if you haven't watched the previous videos, my recommendation would be go ahead and watch those. Because when we start talking about passive limitations, there's going to be certain aspects and key understandings that have to be understood in order to be able to get that. But this is what we call in our previous videos the three leaky buckets. And in the three leaky buckets, if you have sufficient basis in your partnership, and again, we're talking in context of partnerships here, but if you have sufficient basis in your partnership that allow you to take the losses, those losses are going to leak out until they get to the at-risk limitations. And if you have sufficient risk in the partnership, they're going to leak out to the passive limitations in order to be able to see if you can take those. Again, if you haven't seen the other videos, please go ahead and take a look at those. I think it's going to benefit you greatly in order to fully get everything that we're going to be doing here. And so in the next video, the slide that we're going to see, so we talk about passive loss limitations, and the question is, are you passive? And this is kind of like one of those things. The way I've kind of explained it to students and to clients alike is, passive loss, passive activity is kind of like love. You know it when you're in it. Now, of course, the IRS doesn't have a rule that says, well, we'll know it if you're in it. I mean, there's certain times when they write rules that seem to be kind of like that, where the IRS gets to make a determination and then you just kind of have to go with it. But when it comes to passive activities, there are actually some triggers that you have to hit, and usually what it is how much time are you putting into the activity in and of itself. So I'll give you kind of two drastic examples that kind of show how it is. So in the active partnership, very good example. We're a CPA firm. I'm a single member. I'm a single member LLC who's taxed as an S corporation. But if I had 4 or 5 different partners in this firm, I come to work every day to do tax returns and produce products so that our clients can receive their tax returns and their tax filings. I have other partners who would do the same thing, and so they come to work every day, they produce tax returns get filed, everybody's happy, and everyone goes home. That is going to be definitely an active partnership interest, where I come to work every day, this is what I do on a daily basis, we make money, I go home with my money, and that's kind of what ends up happening. Sort of on the opposite end of the spectrum, you'll have where you've got a 100% passive, where there's a CPA firm that I know that is down in town, and what I've done is I go to them and I say, look, I'm a CPA, you're all CPAs, we're going to form a partnership, but I'm not going to do any work. What I'm going to do is I'm going to give you guys $200,000 and you can go set up the partnership, and then what's going to happen is that I want to be drawing investment income off of this. So as the partnership makes money, I get paid. So on my $200,000, maybe I make a deal with them that says, look, I want to make sure that I'm receiving an equal partnership interest in this. So maybe there's 4 people involved, myself and 3 others. Each of us gets a quarter apiece. I'm entitled to 1/4 of the profits because that's the deal that we would go ahead and set up. Now, we set up anything. And one of the cool things I like about partnerships is extremely flexible. If I'm putting up all the money and I've got 3 people who are going to work their butts off, maybe in the beginning, I get a 50% profit interest. Maybe I get 100% profit interest for the first 2 to 3 years, and then the other partners get guaranteed payments. There's a lot of stuff that we can do in a partnership which basically says, look, we're going to set it up the way that we end up doing it. But in that example, I don't go to work every day. I don't prepare tax returns. I don't prepare audits, as a result of which I'm only there. My money is actually working for me in order to generate additional cash. So as a result of which I would be passive in the activity. Now, if you take everything as a whole, obviously life doesn't fit into one extreme versus the next. Normally, it's somewhere in between. So, very good example. I do have a client who is a partner in a partnership. He goes in probably about 1 day a week in order to do a little bit of work. Because he's the financial guy, so he does all their bookkeeping. He does all of their stuff of that nature. And then what ends up happening is, the other 4 days of the week, he does other things. Is that person active in that partnership? And my answer would be yes, provided that they're actually going in and doing work and receiving receiving some type of income as a result of the fruits of their labor. Now there are times where, and I don't have any clients that are like this currently, but I used to work in a previous firm. I used to work with some clients who, what happened is they would invest money in a partnership. So, for example, maybe they're going to start a law partnership, and there's one guy who's basically like, I'm 60 years old. I really don't want to work hard for the rest of my life. I've already worked hard. I've already made all of my money. Here's what's going to happen. I've got 3 of my associates that have worked with me in the past. They're going to go off and form their own partnership. They come to that partner and they said, hey, we need money. So he said, okay, fine. I'm going to front you guys $500,000 to go start your partnership. As a result of starting that partnership, they're able to go do that. He receives funds to be able to receive on his, based on his investment. That said, they did have a deal where he would go into the office about once every other week, and then he would attend meetings. He would help them out, and periodically, if they had a very difficult case that he was an expert in, they'd tell him, okay, we're going to pay you X number of dollars in order to be able to get this, and that would be a guaranteed payment. Now, to that individual, obviously, it's more of a passive activity than it would be an active activity, and so that's where we kind of get into. It's kind of like love, where you know it when you're in it. But again, the way the IRS looks at this is, is it trade or business? And now, trade or business is usually an easy hurdle to get over. So what happens is, if it's a trade or business, now in every example that I've given you, all of them are trade or businesses. Now I put into parentheses here production of income, and what is that? So under the IRS code, there are basically 2 different. I'm saying 2. There's actually others, but there's a distinction between 2 specific types of activities. One of them is a trade or business, which is not really fully defined in the IRS code what a trade or business is. But then they have this thing called production of income. And so activities that you usually see that are classified as production of income are going to be your rental properties. You're also going to see royalties. So if I own a piece of land in the middle of Texas, it develops, has an ability to, there's oil underneath. The oil company calls me up and says, hey, we want to dig on your land. Can we dig on your land, take the oil out of there? Sure, absolutely. Go ahead onto my land and dig. And then you can pay me a royalty as a result of any of this. That is what the IRS tends to call a production of income. Now, and there's certain differences that happen between trade or business or production of income, and maybe I'll make a video on that later on. But generally speaking, trade or business, it's sort of an idea that you're going out and actively going out there and trying to make money through your labor and through your expertise. Production of income, generally, it's not because of some specific expertise that you have, but more or less you're investing in an activity, and as a result of which money is coming out. Generally speaking, in production of income activities, most of these are going to be considered passive. And part of the reason why the most popular production of income activity that most people run into in their tax return filings is going to be the rental real estate. And so what will end up happening is they have their rental real estate. They're going to go out and they do their they build they have the rental property that's out there. They go ahead and they shell it out as as an activity that they're going to go do. And so the thought, it's not like you woke up one day and said, oh my gosh, I'm like an expert in renting rental properties, and so I'm gonna go out there and I'm gonna rent these rental properties. That's not how that happens. Usually what happens is you have a house, you decide you can't live in that house anymore for whatever reason, and so instead of selling it, you decide to rent it out. Now there are a few clients that I have that it is their business. and so, like I've had a client in the past who was retired, and then after he retired, he took all the houses that he owned, turned them all into rental properties, and now that's 100% of what he does on a daily basis. That would no longer be a production of income activity, but probably go towards the trade or business, in that sense. So, by definition, rental real estate is passive under the code section 469, which actually talks about that. And the reason why they made it that way is because the thought process is that if you're doing rental properties, 9 times out of 10, you're doing it as a side gig. It's not something that you're doing actively. Now, there is a way to get it to change from production of income to trade or business if you're a real estate professional. We're not going to cover a lot of that rules here in this video. Again, that might be something that we do later on, but we could talk about that later on. The next question that ends up happening with passive income is it something that you materially participate in? And the way the IRS defines material participation, this comes all out of 469, code section 469, which is that it has to be regular, continuous, and substantial. So in the example with the 4 lawyers, where the person says, I'm going to give you $200,000, and then every 2 weeks I'm going to show up at your meetings and maybe offer some guidance, and then if you need me for something that's big or something that's beyond your guys' capability, but maybe I've got experience on, I can help you out with that. That's not really substantial. The money is. Obviously the money is substantial, but the materiality of participation is not substantial. I'm going in once every 2 weeks. That's not a significant amount of time that's going on. Now, is it continuous? Yeah, every 2 weeks I'm going in. Yeah, that meets, and it is definitely regular, but it's definitely not substantial. Now, the other thing is that take that lawyer, instead of him coming in once every 2 weeks, maybe he shows up whenever he's called. So then, is it regular? Not really. Is it continuous? Kind of. Hey, I'm in the Lake of the Ozarks this week. Not available to show up to a meeting, so I'm not going to do it. That would be a break in that continuous. And again, we talked about it down below. The rental real estate, unless you're a real estate professional, generally speaking, is going to automatically be considered a passive activity. And so the way that they do the reporting of passive losses on the tax forms is going to be using a form 8582. Now, we've talked about this with the basis limitations. Basis limitations, none of that gets reported on a specific tax form. At-risk limitations does get reported on a 6198. The passive limitations gets reported on the 8582. And with regards to passive activities or passive partnerships that you're going to be dealing with, generally speaking, are going to be reported in this what I call box 3. Box 3, which is going to have activities with net income, activities with net losses, and then if there's prior year net losses are not allowed, that's kind of what they're going to do with a lot of that. Now, if you're part of you could be a rental real estate partnership. We have several clients that do that here at Beta Solutions. What happens is that they form a partnership. They go, the partnership goes out and buys several different types of houses, and as a result of the house, as a result of the houses generating rental income, what happens is it'll go to a K1. You'll receive the K1, and box 2 on K1 for 1065s is net rental income. And so if you have rental income, it'll show up on box. If you have income, it'll show up on box 1A. If you have a loss from that, it'll be on 1B, and then if you had any prior losses in the previous years, it'll show up on 1C. And so we fill these things out, and we've talked about this in the at-risk limitation video. Basically, what ends up happening is if you have a partnership that doesn't have a passive nature to it. So, for example, the 4 of us are CPAs who form a partnership. What's going to end up happening is you don't have to file an 8582 if the only activity that you have on your tax return is an active partnership that you're working in. There's just no reason for that to happen. So so a lot of times firms won't. If you get your tax return, you got a passive activity you don't have to, you won't put, you don't have a passive activity, you won't fill out an 8582 on that. Now, that said, if you do have passive activities, but you have no losses, technically you don't have to fill out an 8582 either. Most firms, they'll go ahead and force the tax return to provide it. And we do here at Beta Solutions, just because we want it to get kind of recorded, and so that it's been known as considered and looked at. And so, you only have to fill out one 8582. You don't have to fill out an 8582 specifically to each activity. It's not an activity-based form as other forms can be. So it's something that you don't really have to work with too much on that. The application of losses and excessive passive losses. So, getting back to our leaky bucket situation, if you come here and you have basis limitations, but you've got sufficient basis, and it goes to the at-risk, you have sufficient at-risk, your risk limits, you have sufficient risk in the activity, so it leaks down to the passive. If it gets here and it's a passive activity and you don't have sufficient passive income, your losses are going to be suspended. And so what happens is that they're going to be suspended, but they're going to be carried forward. Now, one of the cool things about passive losses are you're going to be it's going to carry over to following years until you have one of two things that's going to happen. You have income or gains to cover the covered losses, or you dispose of the activity. So, for example, and this is a very common thing that we have with clients, they own a rental property. They own the rental property for, say, 10 years. Every year they have a tax loss on the rental property. Cash, they're doing fine, but they have a tax loss. And so it builds up those losses over time. 15 years later, they get an offer to buy the house, and they're like, I can't turn this down, so I'm not going to. And they sell the house. What ends up happening is that all those losses that have been built up at that time, they get released at that point. And so that is actually very useful. I have a lot of clients that if they don't get to take the passive loss immediately, they get upset. And I get it. Obviously you want to take losses if you have losses immediately. I don't think it's necessarily a bad thing, and I'm talking more from a global view when we're talking about the actual activity in and of itself. And part of the reason why I say that is when you sell the house, or the interest in the partnership, and you have all those losses that get freed, normally what ends up happening is that it reduces the amount of tax that you're going to have to pay on the disposition of the house or of the partnership interest to a significantly low number. And I've even had some situations. I had one time where I had a client that we ended up wiping out almost half their income, because they sold a house that had generated 20 years worth of passive losses that they said we're going to go ahead and sell. And so it ended up working out really nice for them in that year, because when they sold it, they technically had a gain, but because they had so many passive losses in the activity that were trapped over time, it ended up wiping out the gains that they normally would have gotten taxed on. Okay, so anyways, that's all we got to really say about passive losses. First of all, let me just say, if you've watched all 4 videos, I want to say thank you very much for watching. We really appreciate it. If you've liked this video, we would like to go ahead and hit the like button. That way we can go ahead and keep spreading our message around even more. And then if you really like the series and you liked all 4 of these videos, we'd like it that you would go ahead and hit the subscribe button so that you can continue to get updates. This is season 3. We're going to be putting out more videos over time. We just want to invite you to come and look at some of these videos. Hopefully they do some good for you. But if you have any questions, you can feel free to reach out to us at Beta Solutions at www.betasolutionscpa.com. Again, that's www.betasolutionscpa.com. And just want to say thank you very much, and thanks for watching our video.